Today's presentation is Crush the Markets with Options. I'm going to share a few strategies with you today that we love to use here at Trading Wins. I'm going to go through some of the basics first, quickly. And so for those of you who are a little more advanced, just bear with me, and then we'll get to the strategies. We'll try to pack in as much as we can with the limited time that we have available. Now, for those of you joining us for the first time, here at Trading Wins, we are a group of pro traders with well over 30 years of experience. We're real traders and teachers, and we've been developing our own strategies and systems and teaching people from complete beginners to experts around the globe. Now, in today's presentation, I will, again, cover some basics on options, then tell you why and how we like to trade calls and puts, as well as how to trade during periods of high volatility, and specifically talk about a way that you can trade earnings. Unlike most people do, we'll show you how we do it here, and also going to show you a way that you can protect your positions with options, and also talk a bit about who actually really makes money in the options market and how you can as well. And then, time permitting, we'll get to as many of your questions as we possibly can. Please remember that trading can be extremely risky if you don't know what you're doing, so please do not trade with real money unless you're completely comfortable with the system you're using. Now, a few poll questions here. Out of curiosity, how many of you on here have seen me present at an event or webinar such as this before? Please take a moment and enter a yes or a no into your chat. I'd really appreciate that. Thank you very much. We've got another great turnout here. Investor Inspiration always puts on a great event. Thanks for having me again today. A couple more questions here for you. Out of curiosity, how many of you have actually traded options before? Again, please type in a yes or a no. Okay, decent balance. There's quite a few no's. That's okay. We'll do our best to give you all the specifics you need for these strategies today. And lastly, for those of you that have traded options before, on average, how many option trades do you place per month? Is it 1 to 10, 11 to 20, or are you very active? Please take a moment to enter that number, and then we will get right into the presentation. I'm just going to take a sip of my coffee here. Excellent. Thanks, everyone. Really appreciate that. Okay, so when it comes to options, there's a lot of myths out there. I'm going to try to clarify a couple of them here for you today. A very common myth is that they can be very complicated to trade. The actual truth is that they can be very simple to trade, okay? Another myth is that they can be extremely risky. In the media, that's really all you hear when it comes to options is be careful. Options can be extremely risky. Well, the actual truth is that once you know how to trade these, they can be extremely safe, much safer than just trading stocks. So the key to success when it comes to options is knowing when and how to trade them. And I do my best today to try to clarify that for you. Now, I'm not going to, since we have a limited time together today, I'm not going to go through exactly what a call is and what a put is. I'll just leave this on the screen for a moment so that when you receive the recording, you can pause it and read through it. But all this information is available free online for you. Okay? I want to spend as much time as I can on the actual strategies with you today. Okay? Now, a few of the terms you do need to know before we carry on. One is options premium. What is options premium? Well, one option contract is the equivalent of 100 shares of underlying stock. So, for example, if you're buying one call option at $1.50, you actually have to multiply it by 100. Okay? So that your total cost to buy that call option would be $150. So what type of options can you buy? Well, you can certainly buy stock options. They're available on thousands of stocks in the U.S. There's approximately 4,300 of them, and now They have weekly expiries too. It's become a lot more popular in the last few years, and it's actually become a real opportunity, especially for option sellers, and we'll touch on that a bit more later on in the presentation. You can also buy options on the indices, most popular being the S&P 500, the SPYs, and the SPX. And then, of course, you can buy them on futures, crude oil, gold, wheat, coffee, corn, you name it. Anything out there pretty much has an option available these days. An in-the-money option, a very common term, in-the-money option, is a call option with a strike that is below the market price of the underlying, okay, or a put with a strike above the market price of the underlying. An out-of-the-money, or OTM, option is the opposite, a call option with a strike that is higher than the market price of the underlying, or a put with a strike price that is lower than the underlying. Okay, and an at-the-money, or ATM, option is the strike price that is the closest to the current market price of that underlying. Okay, now every option is made up of intrinsic value, which is the in-the-money portion of the premium, okay, and extrinsic value, or otherwise known as time value, which is the difference between the option's market price and its intrinsic value, okay? And then a very important term is implied volatility. Now, this is the estimated volatility of the security's price, okay? In general, implied volatility increases a lot more when the market is bearish, and it actually decreases when the market is bullish. This is really because of that panic that sets in when the market is selling off. In other words, bear markets are always perceived as being a lot riskier and has a lot more volatility because people tend to panic, and that flush or that move lower happens much quicker than the move upward during a bull market. Okay? Now, here's a few facts on options. Number one is they're only risky if you don't know how to trade them. Okay? We'll try to show you a few ways you can use them today. And another fact is that over 80% of all option contracts expire worthless. That's not a myth. That's an actual truth. They do, and we'll tell you how to take advantage of that in a moment. Okay? But what ends up happening is most people only buy options. Very few of them actually sell. And they do so, they buy these options without taking fair value or that implied volatility into consideration. So what ends up happening is that they buy overpriced options and end up losing money even though the underlying stock has moved in their favor. Okay? So what happens as a buyer of an option? When you buy an option, there's only 5 things that can possibly happen with the underlying stock. 1, it can move greatly in your favor. 2, it can move slightly in your favor. It can do nothing. It can remain flat and trade sideways. Or it can go slightly against you, or it can go greatly against you. Now, here's the difference between an option buyer and an option seller. When you're buying an option, if that position or the underlying stock moves greatly in your favor, you will definitely make money. If it moves slightly in your favor, well, you might make money. And this is where that implied volatility, okay, and fair value come into play. If you don't know how to use that or calculate that, and you are overpaying for your option, even though the underlying stock will move slightly in your favor, you will still lose money. Okay, so you will only make money here if you bought an option that was priced appropriately. Okay, but if the underlying remains flat or moves sideways, you will lose money. If it goes slightly against you, you'll lose money. And if it goes greatly against you, you'll definitely lose money. So in other words, when you're buying an option contract, you really have, at best, a 2 out of 5 chance of making money. But in most cases, because most people don't know how to use that implied volatility, they have a 1 in 5 chance of making money. When it comes to selling option contracts, the same 5 scenarios can play out with the underlying stock. The position can move greatly in your favor, slightly in your favor, it can remain sideways, it can go slightly against you or greatly against you. The difference when you're an option seller is that if it moves greatly in your favor, you're making money. If it moves slightly in your favor, you're going to make money. If it remains sideways, you're going to make money. Even if it goes slightly against you, you will make money. The only time you will lose money as an option seller is if the position or the underlying stock goes against you by a large amount. Okay? So the flip side is true here. You have a 4 out of 5 chance of making money. Remember, over 8% option contracts expire worthless, and that's why options really have about an 80% chance of making money on that position. Okay. The other thing you need to take into consideration is time decay. This is that time value portion of the options premium, or the extrinsic value. Slowly over time, as that option contract gets closer to expiration, the time value will erode. Okay. Now, the bulk of the erosion will happen in the final 30 days of that option contract. So if you're a buyer of an option contract, you want to give yourself as much time as possible. Ideally, you want to have at least 90 days to expiration. But the key here is that you want to be out of your long position before there are less than 30 days to expiry. Because during that last 30 days, that time portion of the premium will, the erosion will accelerate. Okay? On the flip side, if you're a seller, you want to sell options with no more than 40 days to expiration, ideally less than 30. Why? Because you want that time erosion. You want that theta decay in your favor. Okay? Remember that. So when it comes to option strategies, there are dozens out there. Yeah, there's long calls and puts, there's protective puts, calendar spreads, you name it, all the way to the more complicated strategies such as butterfly spreads, iron condors, etc. The key, though, is to understand when and how to use each of these strategies. And the real key is to understand that you don't need to trade them all. You only need to trade excuse me, the ones that make you money. Okay? So on that note, let me share with you a few of the strategies that we like to use. Number 1, buying calls and puts. Here's a way that you can trade Starbucks, for example, for $1 or less. Okay? Let me bring up my charts and walk you through this. So here's a chart of Starbucks. Okay? If we look at the option chain here. Now remember, Starbucks is trading at 54.25, for example, right now. So if you're going to buy 100 shares of that, it's going to cost you over $5,400 to own 100 shares of Starbucks. Okay? Now, if you're buying a call, and we go out to September, and we want, remember, we want about 90 days, probably more. We can even look at October's here, okay? If we look at the October calls, there's 101 days to expiration. That gives us plenty of time for a trade to work out in our favor. Now, if you go here to the 57.5 strike, you can pick these up for $1.04 to $1.09. Okay? So instead of $5,400, okay, you can pick up a contract here, the equivalent of 100 shares, for about $104, $109. Okay? That's one way of doing it. Now, when it comes to buying a long call, you do have to take delta into consideration, and delta is the amount that this option contract will increase or decrease, okay, for every dollar move in the underlying. So in other words, if the delta is 30, okay, and the stock goes up $1, that means your option price will increase by about 30 cents. Okay? So, obviously, if you're buying the stock, it'll increase by the full dollar amount. If you're buying the option, it'll increase about 30 if you're buying a 30 delta. But look at it from a risk perspective. You're buying the stock, you have about $5,400 of risk on the table. This way, you have just over $100, okay? But let's look at this in a slightly different way. We can also buy the stock, okay, $5,400, and buy a 57.5 put for roughly 430 to 445. Okay, so let's do the math on this. We're buying it for about $54.25, and we're also spending just over $4 here. So our total cost here would be about $58.75 or so, $58.80. Okay, but because we have a $57.5 strike, by buying the put, that gives us the right to sell these shares at $57.5 anytime between now and expiration. So our real exposure here is the difference between what we spent, which was about $58.80, and the $57.5. So really just giving us just over $1 of risk in total. The advantage of doing this is that we get to hold this position all the way to expiry if we like, and always, no matter what happens with Starbucks, always have the right to liquidate it at $57.5. Okay, so yes, we do have that $1 or so of risk, but now we have the flexibility to trade this position in and out anytime we want using that. In other words, if it goes greatly against us, we can dump it and our risk will always only be that $1 or so. If it goes in our favor, okay, we can actually sell calls against it to bring in more premium. We can roll up our put, which we'll talk about in a little while. There's many ways we can do it, and that flexibility, that added flexibility, is a real key when it comes to options, okay? We'll talk a bit more about that. Let me show you another strategy here. Let's bring up here and talk about earnings. So many people like to trade earnings. The problem is most people lose money when it comes to trading earnings, okay? So here's the real key when it comes to trading earnings. And let's bring up, I don't know, let's look at a chart of Apple. Here. For some reason it's not coming up here. Let's give it a bit more time. Let's try this again. No. Okay. While I try to bring up a chart here, or the option chain on one of these tickers, I can tell you that when it comes to earnings, most people will, there we go, it's coming back now. Okay, so let's see if we can go back to Apple. Most people, what they'll do is buy a call or a put, or both, the day before or the day of earnings, expecting a gap one way or the other, and they expect to make a ton of money. The problem that they have is what we call a volatility crush. So if you go to the option chain, especially, or at least on Thinkorswim here, and you collapse all the option chains, if you look to your right, you will have your implied volatility numbers here for each expiration. Now, you'll notice that on average, they're all within a certain range. For example, on Apple, it's a mid-20s, okay? Now, we have this outlier here. We have 130% here on these minis. Not quite sure why, but what you'll tend to see leading into earnings is that the strike price or the expiration that happens just after the earnings release will spike like this, okay? So it'll usually go upwards of 100%. So the difference is that as soon as that earnings announcement comes out, as soon as it's released, the implied volatility will drop back in line with the average. So in other words, if it was at 100%, okay, and the earnings came out and it dropped back to 25, that means you would immediately lose 75% of the value of that option contract. That's why people lose money. That's what we call a volatility crush. Okay, so in other words, you're buying that call before earnings. It gaps up in your favor, and you're expecting to make a ton of money, but you actually end up losing money. Why? Because 75% of your contract's value is gone immediately just by the volatility crush. Okay, so how do you get around this? How do you actually make money trading earnings? Well, the best thing to do is to trade into earnings without trading the earnings announcement. In other words, if you look back at the earnings, the previous earnings, and on here, these little red dots here are the earnings announcements here on my chart. What you'll tend to find is that there are stocks that will tend to move into earnings. And a good example would be Netflix, for example. Okay, so Netflix tends to move into the earnings. And what you want to do, not sure why my charts aren't working properly here, but I'll talk you through this. The two to 3 week period before earnings, okay, 2 to 3 week period before earnings is when you're going to get that volatility spike. Okay, so your option contract will increase in value just because of that anticipation of the earnings release and that spike in implied volatility. And many stocks will also give you a move ahead of time as well. Okay, so what you want to do is look for a proper setup, with whatever strategy you're using. Okay, you want to look for a buy signal or a sell signal leading into that announcement. Okay, about 2 or 3 weeks before. And if you get that and you're in throughout that move, not only can the stock move in your favor that way, but also that implied volatility increasing will increase the value of your contracts. And actually, even if the stock moves against you, because you're getting that implied volatility spike, okay, it's also, it kind of eliminates the risk at the same time. Okay? But the key here is to be out of that earnings, out of that stock or that option before the actual earnings are released. So the day before or the morning of, if the release is after market, for example. Okay, so that's another way that you can actually play earnings the safe way and put that implied volatility spike in your favor rather than have the crush against you. Let me bring up another strategy here and share that with you. And we talked a bit about this before. How can you use options to protect your portfolio? Well, those put contracts go a long way. In other words, the example on Starbucks that we used, let's go back here, okay, if we can. And, if you bought the stock and that put, the put automatically locks in a price that you can sell your shares at, okay? But now, if the stock moved higher, let's say you got in here and the stock moves up, okay? You can actually roll up your put to lock in more profits. And the nice part about this is, especially if you go further out in time, if you own the October puts, like we were talking about, the 57.5 puts, and they're $4, you can actually roll up, say to the 60 call here, but shorten the time. For example, if you got a nice move right away, okay, and you rolled up in strike, down in time to the August here. Look at the 60 calls here, okay, and look at the 60 calls here. So if you sold these and rolled up, okay, yes, you would have to put a bit more money into it, but you're going up in strike. So your net adjustment means you're locking in more profit, okay? A very smart move that you want to do on a regular basis if you're trading with stocks, okay? And you can always use those puts to put that that floor on risk, okay? In other words, if you bought that 57.5, that is the least you're going to sell that position at, okay? Remember that. One last one here for you. I can probably squeeze in here before we need to go. Let's have a look here. generating a steady income every month. Remember when I showed you the difference between the buyers of options and the sellers? The advantage is definitely with the sellers. So how can you use that to your advantage to or earn a steady income with the markets? Well, with credit spreads, okay? Simple credit spreads. You can, let me bring up my charts here. Okay, so what a credit spread is you're selling one contract and you're buying another one for protection, okay? So in other words, let's say you got a buy signal on Starbucks right here. You're anticipating that move higher, okay? What you can do is sell a put credit spread. So what you do is you sell a put contract and then you buy a lower put for protection, okay? So from an option chain perspective, let's go back here. And if we were going to, for example, sell the 50s, okay, here, we collect that 87 or 88 cents, okay, and we can buy a lower strike, say the 47.50s, for protection. Now we'd pay about 45, 48 cents for that, okay? So the difference is we'd be collecting about 40 cents for that. Now our risk is the difference between the strike prices, in this case 2.5, minus that 40 cents, okay? So your risk reward on credit spreads is always against you. In other words, we're risking about $2.10 here to make 40 cents. Seems out of whack. But when you consider that you have an 80 to 85% chance of being right on this position, of making money, 80-85% of the time you'll make money with credit spreads, that completely changes things. And not only that, this is just your opening positions. There are ways to repair these and adjust them if it starts going against you. Okay, so it can be a very, very effective strategy. Let me give you my rules of thumb on credit spreads before we move on. So in other words, what you want to look for from a premium perspective, you want to collect about 20% of the difference in strikes, okay? So if this was anywhere from 10 to 20%, okay? So if you were collecting, or sorry, if you had a $10 wide strike, because on some of the more expensive stocks, like the Teslas of the world, you are going to have $10 wide strikes. If you have a $10 wide strike, you want to collect anywhere from $1 to $2 of premium. Okay, anywhere from 10 to 20. The closer you can get to 20, the better. And the second rule that you should always follow is that once you're in that position, okay, and you're getting closer to expiration, and you're already in a position where you have 80% profit. In other words, let's say you had collected $1 in premium, and now they're only worth 20 cents. Okay, you're already 80% of the way there. You want to close that out. Okay, that way you eliminate the rest of the risk of this possibly turning around and going against you. Okay, so those are the two rules of thumb I use. I like to collect about 20% if I can in premium of the difference between the strikes, and as soon as I'm about 80% in profit, I take that off the table. Okay, so let me recap for you here. Then when it comes to options, okay, the advantages, the real advantages are your cost efficiency. Okay, you can trade these with a very small account. So remember, like the Starbucks example, rather than spending $5,400 on 100 shares of Starbucks, you can spend $100 and hold the same amount of leverage. And you can really leverage this with a larger account because you can buy multiple contracts for a very small risk. Remember, when you're buying an option contract, the most you can lose is what you pay for them, no matter what happens. So if you're only spending that $100, that's your maximum risk, okay? The other nice thing is that there is a lot less risk for that exact reason. You know, when you're putting $5,400 into the market, anything like a flash crash, 9/11, anything like that can happen at any time, okay? So your portfolio is always at risk. That's why you want to protect it, either with a put or you just want to buy a call. You have a lot less risk, okay? Another real advantage here is the higher potential returns. Okay, what you're actually doing is you're spending less to earn more, because as you buy multiple contracts, if the position goes in your favor, okay, the amount of profit you make is going to increase exponentially, but your risk will only ever be what you paid for those option contracts. Okay, and the best advantage here is the greater flexibility. And we always like to say you have many options with options. There are so many ways that you can play with these contracts and so many different strategies that you can learn how to adjust positions and so on, where you can really increase your earnings without taking on much more risk. Now, I'm actually going to bring on our coaching coordinator here to answer a few questions, and then we will move on. We have a question. I'm assuming we have a lot of questions.
We do have a lot of questions,
Yes.
Vince. It's always an interesting topic. Always interesting being here with you. The most popular question we've had over the last couple of minutes is trading credit spreads risky?
Again, only if you don't know how to put them on and when to put them on. That's the real key, is at what point do you initiate and where do you put that short strike? Because that short strike is everything. The last thing you want with a credit spread is for the market to pull back and go below your short strike.
Karen was asking, Vince, with earnings seasons upcoming, are there certain strategies that you prefer than others?
Yes, actually, there's a couple other earnings strategies that can be very effective with earnings. Just don't have the time to go over it here.
She was also asking, what are some of the stocks on your current watch list?
Yes, I mean, there are, I look for stocks setting up with a certain technical pattern. Many of you who have seen me present here before, we've displayed our strategies before. We use those and many others to pick our spots, but we trade almost exclusively with options now.
Philip says, Vince, I'm trading with an account that's about $1,000. Can I still use option strategies with that kind of money?
Oh yeah, absolutely. I mean, the real nice part about options is that you don't have to spend a lot, okay? But you can really use them to grow your account, and the real nice thing is because you know exactly what your risk is, you define that risk and what you pay for that contract, you can protect your downside, which is incredibly important when it comes to having a small account or trading a small account, because it's easy to blow that account out if you don't know what you're doing.
You remember back in the day when you try to put on a butterfly or a condor, positions that had different legs, you could pay $1,000 almost in commissions.
Yes, you can. With the more complicated ones, that's right. But again, you can really exploit it at the same time and really make about 10 times your money.
Nowadays, with the discount brokers, you pay maybe a couple of bucks to put on a spread like
that. Yeah, I mean, nowadays, the nice thing is that commissions are really insignificant.
Vince Lena says, I'm not sure I quite understand the concept of spread. Should I be putting them on one leg at a time, or can I ask my broker to put on a spread?
Oh no, you can definitely enter your order as a spread. Absolutely. Let me, I do see there's a lot of questions. Let me tell everyone about a course we have coming up, and then we'll answer a few more. Coming up next Friday, July 17th, 1 p.m. Eastern, we're going to be holding our pro class on how to trade options, how we trade options. And during this class, I'm going to show you how you can earn a steady weekly or monthly income using credit spreads. And I'm going to go through the details of exactly where or how to put these on. And not only that, but more importantly, how to adjust them or repair them if it goes against you. Okay? I'm also going to show you a nice strategy with butterfly spreads that Oh, there we go. Okay, sorry. I think the audio had gone out for a moment there. I hope everyone can hear me now. Yep. Okay, so I'll show you a way that you can put on butterfly spreads. I'll break them down for you where I'll actually show you a very simple way of trading them, where you'd only be investing about $90 to make 10 times that amount. And one of the ways is with earnings. So when we have earnings season coming up now, I'll show you not only how to find the stocks to trade these on, but how to put these on. And I'm also going to teach you a couple of different delta neutral strategies. What that means is that you can make money whether the stock goes up or down, okay? And especially when you find a stock that's in a channel, in a sideways channel, you can really take advantage of these delta neutral strategies. And most importantly, how to repair bad trades. A lot of individuals end up closing a position at a loss where it's really not necessary. There are ways that you can repair these trades fairly easily without putting much more money in, and knowing or having this skill can go a long way with taking your trading to a next level. Okay, and also during that class, while we're going through all this material, we're also going to be looking for trades that we can all walk away with and put on for the coming week. Okay, the link for this class is tradingwins.com/crush. But before you order, let me tell you exactly what you're going to get so you know that it's right for you. Right shortly after you complete your order, it takes about half hour or so for it to completely process. You'll receive an email with a link to the previous pro class that we did. That way you don't even have to wait until the 17th. But regardless, we will save you a live seat for the class on the 17th. It will be recorded if you can't make that date. And we're going to throw in a 30-day membership to our pro service. Now, let me tell you a bit about that. Our pro service is the most powerful way to get access to all our systems. Remember, aside from our option strategies, we have many technical analysis setups that we use with our trading, some of which we haven't even released to the public. But in addition to that, you're also going to get trade alerts showing entry stops and targets for any trades we take. You'll have access to premium nightly videos that'll show you how we trade our various systems. We send these out every Sunday to Thursday. You'll also get access to our members-only weekly chat, which is one of the most popular features of our membership. We meet every Thursday morning from 10 to 11. Again, it's recorded if you can't make it live, but you can come into the room, ask me any trading-related question you like. They're fantastic sessions, and in addition to all that, you get access to our library of past educational sessions, okay? And you can always reattend a pro class at no charge. So all of this together is a $982 value, but for anyone on this webinar today, we really want you to see what we do here at Trading Wins, and so we're practically giving it away, only $47, okay? Again, it's tradingwins.com/crush. We do limit the class to 50 people. We have to get through all those questions, but this is everything you're going to get here, and the recording that you're going to receive of the last class is well over. Actually, I think it went 3.5 hours.
Almost four.
Almost four hours. Yeah, my promise to you is that I will stay as long as I have to at that pro class to answer every last one of your questions. Okay, so in that last class, there's a lot more material than what you're seeing on this screen here with the questions that come up and the trade examples. It's really a fantastic class.
As you said that day, it's a bladder-busting good time, isn't it? You'll need to take a washroom break, and we usually do.
We'll take a couple of breaks.
Okay, now the questions are coming in fast and furious now. If I can't attend the session on the 17th, Vince, will it be recorded?
Yes.
When will I receive the recording of the previous class?
It usually takes about half hour for your order process, within a half hour. I should say you're going to receive about 6 recordings, okay? You'll receive the one of the last class, you'll receive the one of the live class on the 17th after it's over, but remember, those live market chat sessions that we have every Thursday morning, you'll also be receiving a recording of those, so you'll get at least 4 of those over the next month.
How much of the discussion during the pro class will be on exotic strategies such as condors and butterflies? That's from Tom.
Well, we will cover some of that as well, whatever we can fit in during the session. Absolutely.
Vince, will you teach us stop-loss rules for options as well during the pro class?
Definitely, absolutely.
do you base your stop loss rules on the underlying or on the option itself?
It depends on the situation, but most often on the underlying. But again, we'll go over that in detail during the class.
Timothy says he just signed up. Is looking forward to the class.
Great.
Awesome deal.
See you there.
Looking forward to the 30 days of service as well. What happens at the end of 30 days?
If you're enjoying the membership, you don't need to do anything. It'll automatically renew at $97. But if for whatever reason you'd rather not continue, just give us a call and we'll put a stop to that. We always say it's the world's easiest cancellation policy.
Okay. Rebecca says, in the past I've been able to email questions after watching the recording of the previous class. Can I do the same with this one?
You can always email us questions, absolutely. Even for the live market chat that happens every Thursday, if you know you're not going to be able to attend live, but you have a specific question, email us ahead of time, and I will answer that question for you during the chat so you can hear the answer on the recording.
Leah was asking, can I postpone the 30-day membership to a later date?
Yes, if you'd rather have your membership start at a later date, email us after you order at info@tradingwins.com, and we'll adjust your membership accordingly.
Okay. Vince, what's your current favorite option strategies considering the unsettling news in the market from the Greek perspective?
Oh, lately it's been the delta neutral strategies, and I'll share a lot more about that. We can go through some specific examples during the class. Again, I see a lot of questions on how to sign up for the class. I believe the link is in the chat now. Just click on the link from the chat, and that'll take you to the sign-up page.
Edward's asking, do I need any specific software, or do I need to be using TOS to be able to trade with your strategy?
No, you do not. Any charting platform will do. There's a lot of free resources as well for getting option quotes, etc.
I want to thank Robert, Marvin, Marcus, Sam, Olan, Cliff, Felix, Scott, Gary, Isaac, Gerhard, lots of men, Randall, Kent, well, all gentlemen that have just signed up.
That's very rare. I don't think we've ever had that. Actually, yes. Our membership base is about 50-50, is it not?
It's just about.
Yeah.
Just about. It's always nice to have a nice mix on. You get a different perspective on things.
Yeah, that's a real benefit here. The Q&A in the classes are a real advantage because we get people from different levels of experience, and the questions that come up lead to other topics, so it's great. That's another reason why we like to send you the recording of the previous class too, because in every class the Q&A is different.
Vince, how much of the time during the pro class will be spent on basics, like what is
Oh, very little. About 20 minutes or so. We'll make sure you have a full understanding of the basics before we move forward, but the bulk of the time together will be spent on strategies. Okay. I don't think you're going to find the amount of material that we're going to cover here, the amount of value we're going to give you, anywhere else for $47. Remember, this isn't, we sell these classes for a lot more. We're doing this to give you an opportunity to see what we do here at Trading Wins.
The previous class was fully sold out.
Yes,
I didn't expect us to go nearly 4 hours.
Right.
I think that's probably the first time we've taken 2 breaks during the session, just because the questions kept coming and coming. I guess it's part of what's happening in the market. Where do you think we are with this whole geopolitical situation with Greece and how it affects your trading?
You know, it's crazy, but the real nice thing is when it comes to options, you can set it up where you don't need to be able to guess direction or know exactly what the next move is going to be. You can not only trade, but you can protect yourself. There's the closing bell, I believe, if anyone else heard that.
Last question. Leonard says, I'm a new trader. I'm a little afraid of options. Will this class be beneficial to me?
Yes, absolutely it will. Again, you don't have to have a lot of experience with this. We're going to cover things step by step. So it'll benefit all of you. Leah is saying the live pro class will be focused on the, no, it's not just focused on delta neutral strategies. There's going to be several strategies. Let me put that screen up again. This is all the material that we're going to cover, plus more, whatever else comes up from the questions. I believe we might be out of time.
It's just about 1 Pacific now.
Yeah.
Reed, as always, enjoyable to be on Investor Inspiration. Thanks so much for the opportunity to let us join you here today. Always a great session. Thank you again, Vince. Last word.
Yeah, thanks to all of you for joining us today.